Hi everyone, this is the 7th of November 2022, final months of the year. But more importantly, we have the big event, which is the budget at the end of January. So that's still 3 months away, but that's going to be the next big thing that will slowly get talked about. And between then and now, the interplay with global markets is going to be pretty meaningful. So the result season is over. Now, everything that happens in our own market will be a function of either its own momentum or what is happening in the global economy. Now, last week's events were pretty decisive, so I was really waiting for them to take a clue on what happens next. But first, let me start by explaining the current technical picture of our market. So definitely I've been saying for a long time, for all my critics now, as markets getting closer back to, we're still not above 18,300 also. But as we get closer there, every day it's like people are screaming and shouting about 19, 20 and 22,000 on the Nifty. I'm still not jumping the gun there. Sure, individual stocks or sectors have done well in all the rotation in between. But our short-term setup still remains bullish because for anybody who knows the daily RMI that we use, the Rohit Momentum Indicator, has been in buy mode since the start of October, which is where we turned positive. But like I said, last week's events were decisive, and so they do play on your mind. Before such an event, I would back off, and which is sort of what I did, at least as far as trading is concerned, and was considering the possibility as to whether it would fall immediately. It didn't. Global markets reacted. Most of Asia did not react, and now they are again bouncing further because some of those markets, specifically Asia, if I look at places like Taiwan, had really not retraced the entire fall. In fact, they were very close to the lows, so it was very unclear how this market will keep falling. China, I've written about that last week, the Shanghai index that actually has shown an impulsive rally, an ABC correction, and now it's gone beyond the 20-day average, and so it looks like a third wave has started. So China is now in a movement of its own. So I think China is becoming the play in the reopening trade, even though they are still denying that they'll reopen. But I put it this way, are you going to shut down China forever? No, which means it's a matter of time only, right? You can say, okay, not today, next month, 2 months later. But the moment you're looking at this scenario, markets start discounting it in advance that yes, we have been through this crisis, the worst can be over, and we can actually start working towards what comes next. And what comes next is the reopening. And so that is where there was a struggle, even in my mind, between what commodity prices are showing and what the dollar is doing. And this is where the divergences occur. But anyway, I'll come back to that topic. The main thing first is to say the Nifty had a setup to fall. It did not. The weekly charts also, in fact, were the ones that were signaling that, because the RMI actually went into sell mode because we fell to 17,000, 16,700. And then that indication only reversed this week. So on the closing of this week, the RMI whipsawed back to the buy side. But the daily, like I said, from the start of October was anyway in buy mode. So there was no real sell signal, actually speaking. But the event played an important role. Now, the event is more of a debate on the big picture. So this is where the importance of the event to the immediate market cannot be there. But of course, day traders and short-term traders feel, oh yeah, event came. If this didn't happen, the event is useless. But for us as analysts, we really want to understand what are going to be the implications of this going forward, because it will impact the market's trends in the coming 3 to 6 months. At the same time, we look at whether the event usually has a short-term reaction. Sometimes it's a knee-jerk reaction. Sometimes the event is so significant that it creates a trend. Now, the history of Fed events is they've mostly been knee-jerk reactions or non-events. Okay, because they tell you what they're going to do so much in advance that the market already knows. So did the market know that we were going to raise 75 basis points? The answer is yes. So that's not what really we were looking for from this meeting. What we were looking for is commentary as to what they will continue to do. But then isn't that what we've been doing all of the last 6 months? The answer is again yes. The reason is that there is this fight, and there are two groups of thinking and two schools of thinking as I listen to various global analysts, hedge fund managers who are trying to weigh the options over here. One group of thinking is that as things turn bad, the Fed is going to be pushed to pivot, because if you're on a path where you're weakening the economy and you're affecting the rest of the world, in a situation where debt levels are very high, which means it will affect sovereign debt, they just might not be able to pull it through. There are also others who believe that the economy or markets will slow down so much that they will back off at some point of time. So if you just go back 4 months, people were saying they will pivot by September. This is the last rate hike that they're doing. Well, they have continued to hike. We are in November now. And now the very same people are saying November is the last. I mean, they're just going to do another 75, then 25, and that's it, because the terminal rate is now at 5. Well, earlier the terminal rate was at 4. So there is this one house. Then there's this bigger view that, okay, inflation is not peaking now, but 12 months down the line, you're going to be hitting maybe 3 to 4%, and that will sort of bring it within the terminal rates range, and therefore real interest rates turn positive, and then they can stop raising rates. But that's like 1 year away. Between now and then, at what point are they going to stop? They have themselves not committed, which is what my, I should call it fun tech video, or fun, I don't know if it's tech, but fun market videos have really tried to explain on right after the event on Friday, because that was going around my head. What did he really say? And so I brought it out in a different way. But that's sort of what he said. He said that we don't know how we're going to really go about deciding when we should go from 75 to 50. We'll think about those points in the next meeting, and if we have to, we may slow down, but they're still not going to change the trajectory. Now there are two schools on inflation. So this is why there are two schools of thinking. One of the guys was saying, they will pivot because they won't let things get too bad. They can't afford to do it. Then there's the two schools who are fighting on the inflation. Okay, so there's this one school that feels that the inflation trend of the last 2 decades, which was deflationary, okay, or disinflationary, has sort of come to an end, and we are now going to enter a phase where inflation is going to remain elevated for a longer period of time. Even if it does come down, it will settle at a higher level, maybe make many spikes higher, and then we'll slowly adjust ourselves to a much higher rate of inflation. And therefore, that school believes we just cannot keep rates where they are. Okay, or which actually means goes to say is that rates may go high, they may come down, but they're not going back to zero. That's sort of what a 30-year bond market chart would also tell. Now, I'm not an expert on bonds. My expertise is more in equities. I've spread it to forex and commodities. But the bond market, while I do track the correlation, that's an easy thing to do. Should I think that a 30-year bond bull market has come to an end? Because when you actually look at bond prices, okay, or bond yields, okay, so bond yields would be downward, bond prices would be upward. You look at a 30-year bond yield chart, you see yields are going down, 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 down in a channel, and that channel's broken out. You've actually broken out a multi-year channel on bond yields. Does that mean we've actually made a major trend reversal in bond yields? And that's, I think, the really big question. And so that requires both a technical and fundamental input. The technicals are there. You've got a breakout. Is this sustainable? And I think that's what some people are beginning to say. They're saying this is a change that's going to be around. Another reason of really looking at it is that, so I was talking to, people I know in the US. They're like, we don't know what the Fed is fighting. Why they're fighting a supply side problem with interest rates. So there are some people who still believe that this is just a supply side problem just because it's showing up in inflation that they can't fight. They're going ahead with this policy stance that it's demand driven, but it's really a supply side issue. To some extent, that is also true, because if you think about it, the Fed is focused on the labor side of the problem, right? The labor market is strong. Unemployment is extremely low. And amid this low unemployment, what it means is that you have a hot job market. And when people are not able to find new people to hire, what they're doing is they're starting to pay people to stay. They don't want them to jump jobs, and therefore wages are starting to move up. Now, why aren't there people to hire? So there's a lot of changes that have happened because of the pandemic. A lot of places, workers have not come back. When I was traveling to Switzerland, I very much saw a very parallel pattern as to what we have already read about in the US, that is certain restaurants actually work at half capacity. Even though everybody is going out, going to hotels, eating out, the restaurants really don't have enough people to serve. So they keep part of the restaurant closed. I actually saw it in Switzerland as well. There was a pizzeria. We went in the afternoon and they were telling other people, see, this is a problem that everyone's facing. We don't have people. We can't open it right now. Probably they had timings for the evening or morning, but they just couldn't stay open all the time, and they just can't work at full capacity. So this is a problem that some of the industries actually face. And so there's also a lot of people who have actually not gone back to work because either they've been displaced as labor or because they got used to the freebies that have been sent out by the government in terms of paychecks, and they got used to living on that. A third pattern, which you also see in India, is people don't want to go back to work, right? They want to work from home. A lot of offices are running at half capacity. Offices are shifting out of their commercial property into rentals and smaller properties, which they would utilize more completely, rather than the ones they were in, which are being utilized at half capacity, because half the people sit at home, except for sales force, which you really need to come to work. Many other people who are in departments which are more intellectual or which require the mind, accounting, things like that, actually finding it very comfortable to work from home. People don't want to. In a city like Mumbai, you spend like 4 hours of your time traveling, just getting to work. And now after 1.5 years of having the ease of not having to do that, people just don't want to do it. It's too frustrating. Okay. And so these patterns are being seen around the world, which have sort of affected things like the labor market, right? People wanting to get paid more, not wanting to shift, not wanting to go to work, and actually not going back to do the same jobs that they were doing before. So all of these patterns have created a shift. The other one, which was also highlighted by different speakers that I listened to, is that this trend of people working from home significantly more has also changed their consumption patterns. So which means they don't go to Walmart and buy the same things. And so if they stocked up on certain inventory thinking that people just go back and buy this, it's not there anymore. So in a nutshell, there are patterns which are very, very different from before. And can you really directly deal with them with inflation, interest rates? The answer could be yes or no. But what other tool does the Fed really have? Okay, can they really just sit back and say, okay, let this happen, it's transitory? Because then what happens is inflation gets entrenched. Now, inflation is also a psychological and emotional thing, right? So that is why it's economics. It's a behavioral science. If people think that prices are going to keep going up, then they're likely to raise prices. Okay, so and this happens industry to industry, not just labor, but it shifts to even sectors. So if sectors feel that, okay, my input costs are going to keep going up, why don't I just raise my output costs? And when it becomes a belief system that prices are going to go up, people's behaviors become like that. They start stocking up inventory at lower prices because they need to sell at higher prices tomorrow, which again creates demand contractions and pushes inflation higher. So this is a multifold effect that really comes out of this whole pattern. And so these are many different ways in which we're actually seeing this elevated inflation. In India, if you look at the CPI data, it was really low. It moved up, came off a bit, but again in the last couple of months, the CPI is beginning to rise. It's almost back at where it was at the peak sometime in between the year, early part of the year. The question now is, are you really going to surpass that level and go higher? We really want to see the 14th October data coming out this month for September. And if inflation data continues to rise, you know what RBI is going to be doing next in the December meeting. They've already written, they had an MPC meeting recently to give an answer to the government as to where they are in inflation and what steps they really need to take. I thought they would actually make some announcements, but they made it clear they don't want to take a mid-meeting announcement right now. But the trajectory for interest rates, and so this is where now the technicals come in, right? We know the fundamental environment, and then we look at charts. And the two major factors, the two macro factors that I'm using to look at and say that fine, the market's going up. So should I just go back to being in the perma-bullish mode that I was in the post-pandemic period, which means from March 2020 onwards, slowly I got bullish and then more bullish and hyper-bullish. Should I go back to being in that kind of behavior, something that I changed in April, saying, fine, we are not in a long-only higher highs, higher lows market, and it's a trading market. Now, the advantage of a trading market is once you recognize it, you can actually trade a 1,000, 2,000 point drop, then ride a 2,000 point rally, then trade another 1,000 point drop. And that's sort of been nice over the last several months. But as we are getting closer to 18,200, 300, 500, now we are breaking past some of the previous highs that we had made, which was close to, I think, 18,150 is the last high we made in August. People are beginning to question, is this a breakout to new highs? And then I go back and say, okay, either I pay attention to this higher high, higher low structure, or I still wait for the macro factors to change. After all, I did wait for markets, especially the commodity and metals markets, to reverse in April before I really paid attention to the rising dollar, because for a long time I was ignoring that because markets were still strong. So when to pay attention to which factor really becomes an important call. Now, should I ignore those factors again? Because those factors are now become entrenched. The rising dollar, the strong dollar is actually a deep trend. It's impacting all global currencies. It still doesn't look like it's over. So now if I actually look at the technicals of the USD INR, I still continue to see that it's heading towards 87 and eventually maybe much higher. 87 just in this cycle. I don't know if this cycle itself will extend, in which case it could even be 90. But at least let's start with that number, which means the weakening of our currency is not complete. Sort of the fundamentals would also align with that, given our CAD still high. We have still got to import oil. Oil prices have not come down. People may say oil is down, inflation will come off. But remember, oil was 20, 30, 40, $50. Now it's like gone to 120 and you're at like 80, 90 and we are saying that, okay, inflation is okay now at $90. Remember earlier, if we thought if at 50 I told you I'll go to 90, you would say the world comes to an end. Now at 90 you say it's okay. So this is psychology, because you've seen 120, 90 looks like a good thing. When you're at 50, 90 looks like a bad thing. This is just psychology. The fact of the matter it is a high price, and at this price, if I have to import, I have to pay a lot more in dollars to really get oil home. And that's a pressure point for the currency. So that's going to remain. The other thing, so how do I really support that? I need to create a good investment environment where foreign money really comes into the country. Now, people think of foreign money coming into your country or going to another country like a switch. Okay, today I like Taiwan, so I'll buy Taiwan and sell India. It doesn't really work like that. The global asset allocators, essentially, they're using indices or models. Okay, so for example, you may be using the MSCI index and thinking, okay, fine, I need to allocate more to a particular country. I'll reduce this by 2 percentage points, increase it by 1 percentage point. The second thing which happens is somebody thinks that, oh, the world is falling apart, I need to pull out money. So he removes $1 billion from global ETFs. All ETFs are forced to sell. It doesn't matter whether it's an India fund. That's partly the reason why FIs were selling last year. They had no choice. They have to sell if somebody is redeeming money outside. So it's not always a simple call. It's not a country call. It may look like, oh, FIs were wrong. See, India's up because our ship flows are strong, or whatever other reason. Because I don't think buying and selling activity really determines prices. It's usually sentiment or some fundamentals underlying that make that improvement. But the FIs were forced to do what they were forced to do. So having said that, your currency situation doesn't change that easily if the global environment still remains negative. So that's one factor that's still a risk. The second one, which I still see as a significant risk, and I've been hearing this even from people in the fixed income side, and you can verify it yourself. Interest rates, in fact, banks have started to raise fixed deposit rates. Interest rates are going higher because the little bit of credit demand that has happened recently on the pickup in economic activity in India has actually seen credit growth at a faster rate than you're actually seeing deposit growth. So there's actually a gap. You can see it in SBI's results. And if that goes on, you have a reason to actually raise rates and get more deposits. So that is why you're seeing the fixed deposit rates really start getting elevated. Now, this is just one reason. There's another one, which is government borrowing. Government was spending more last year. You've seen capex, so capital goods companies have done well. But if the government is really borrowing more to spend, it sort of starts outpricing private borrowers, right? So that's another trend to really be careful about. And that also pushes up bond yields. So then again, I come back to the technicals. I look at the chart. I thought the bond yields, I thought they would spike to 8-9% in 2018 when the IL&FS crisis happened. I turned out to be wrong because you didn't get a full spike. It just went to 8.2 and then started to fall. When that happened and the pandemic happened, I said, okay, fine. That means yields are not going up. Maybe we have started a bond yields have gone down and are starting to go down in India, and you started a bond bull market. Again, yields fell, but they didn't really go below 5%, right? They stopped there. So once again, bond yields started to go up and they've actually broken out. So I have had to step right back and think that the triangle pattern I was actually envisioning in 2018 didn't complete its wave E to 8-9%, but is doing that now. And that's the risk that I really see. Bond yields in India can spike up to 8 to 9%. We are sort of getting now a more fundamental confirmation to that, that you will see above 8% yields. And what risk does that then play into markets? I'll tell you the risk. Say everything remains the same. We have growth happening, earnings are growing. What you've seen in the US is the risk that you would see. When interest rates really rise beyond a point, your valuation models go for a toss. So the first thing which happened in the US, you got a valuation correction, right? You haven't seen a massive earnings decline yet, okay, across the board, maybe in some sectors, but on an average, S&P earnings have been flat. The first thing which happened to technology companies in the US before the earnings drop really started to show up is valuations corrected from where they were. Because interest rates going up, immediately has an impact on valuations. I think that valuation correction is something we have not seen across the board in India. Some parts, some pockets, but not across the board. And that's a secondary risk. So interest rates rising, USD/INR rising in India still remain active risks, which can cause trouble at some point of time. And I think that can impact valuations. Having said that, if I really had to take a 5-year kind of picture for India, yes, I would still think it's bullish for certain sectors that have, consolidated for many years over the last, decade or so, and they started to come out of that in the last year. Those patterns are real, but what stops you from getting a second wave correction? And this is where Elliott Wave analysis says second waves can be sometimes the deepest, because sometimes the news is bad or worse than it was at the beginning of the wave, and that is what causes the selling into a second wave, even though you have had a major turnaround in price. And that could be the stage at which we are inside this whole parameter. The only thing is right now, because of a lot of the rotation, some stocks and sectors have corrected a lot. There are others which are still outperforming, which makes you believe that the previous bull market probably never ended and we aren't going to get that correction. But as long as you have risk on both the currency side and the bond market side, I am saying I might as well mitigate that risk, let it play out. If you've truly done what I've done, which is ridden the entire bull run from the pandemic lows, which is at around from 7,000-8,000 Nifty or 9,000, anywhere you entered, you're today at 18,000. The index is double, stocks have gone up many-fold. Would you be in capital protection mode, or would you really want to go aggressively in risk? Okay, so as an individual, so I'm not a mutual fund, I'm not answerable to anybody. As an individual, I would want to protect capital. I would get invested, but I would be very aware of the risks that the market has, and why I would like to, at any point of time, moment those risks start showing up in price, create a certain amount of cash so that I can take advantage of that dip if it shows up. So that's going to be the strategy, to always be prepared for that situation, because it is a likely outcome. In the short term, the momentum might still be there, prices can keep moving higher, but as and when we get a signal that things are rolling over, I would really want to play protection case. Now, for the people who are saying, no, this is the bull market that has started, fine, I can always get in later on. I mean, people say market's going to 19,000. That's a trade. 19,000 is a trade. We went from 9 to 18. That is an investment cycle. So what you want to really spot is an investment cycle in the market, one which means higher highs and higher lows for the next 6, 12, 18 months, or maybe several years. Why just months? So it's something, not just months, but it should be something that can last for years. That is what I'm looking for. So I'm not looking for being able to confirm that the market's going to 19,000. I'm looking for it to confirm that it's going to go far beyond that in multiples over years. And that is the setup I want to really play. Till that point of time, as there are some of these risks, I will be more of a trader than an investor. And that's, I think, the positioning. Even if I do invest, I'll be willing to step back, create cash again, simply because the market starts to react. And so it means I have to remain on my toes, which is more active management than passive. So when you have a running bull market, you just invest, buy the best stocks or the best sectors or themes and do nothing about it for years. But when you have this kind of a scenario, I always want to manage that risk, because you can say, okay, if you have a good entry, very early in this bull market, why should you even think about, getting out and trade at a wave to pull back? I mean, you still bought at a good level. The answer is yes. It might not matter so much if your entry price is right. So again, that's a choice. But the nature of human beings is this. Most people would not have been convinced that this was a bull market at 7,000, 8,000, 9,000, 10,000. Most of them would have come in after 14,000, 15,000, 16,000. And now at this point of time, that risk would be more for those investors who've come in late than those who were in very, very early. And so each one situation is different. You have to make your judgment call. But I hope this session's really given you an insight about the key factors that the world is facing. Okay, what people are thinking about. They're trying to weigh whether the inflation thematic is transitory or whether it's permanent. And in the process, because the Fed doesn't get it, their stance is very, very simple. We need to keep tightening. Okay, we need to get liquidity out of the system, which has made people comfortable to think that inflation will persist. Once that expectation of inflation is gone away, they will probably ease. That can take 6 to 8 months, 12 months for it to happen. And if it takes that long, even if you keep interest rates elevated at a certain level and not hiking consistently, it is still going to slow down the US economy. Now, will that slowdown affect US earnings? Yes, but will it impact India or emerging markets? Is the really big question. I think to some extent the answer is yes, because the risks to our own currency and bond markets is not gone away. Once those risks are gone away and we are no more impacted by those risks domestically, then I would probably want to say that, yeah, we are completely decoupling from them and going to do our own thing. Do such things happen? It's usually a lead lag. I mean, say for example, you go back to 2001, the bear market in India ended with 9/11. The US market also rallied after 9/11, but it continued to make a lower low in 2002, but India did not. And so the decoupling was just a lead lag. It was a 1 year lag between our market bottoming out first, their market bottoming out 1 year later, and then eventually both were in a bull market till 2007, 2008. So that kind of decoupling or lead lag does happen. You don't get a decoupling right in between something which is happening. So will there be a decoupling when these factors have elevated and completed themselves? Because if you again go back 2001, the US dollar index was in a bull market from 1992 to 2001. So it was like a 9-year bull run in the DXY. Right? It peaked around there and then started to reverse. So the peaking of the dollar itself happened late in the cycle, which is right around where the market started to reverse. And so some markets reversed early, some markets reversed later. So all of these intermarket relationships do occur. Everything doesn't happen exactly at the same time. There is a lead lag. And so we are seeing the same thing now. The dollar's been in a run. It is going to peak at some point of time. We will see some of the macro factors reverse before others. I mean, here's a final one. There's a chart from EWI which has been floating around, which shows that right after every Fed pivot in the past, markets actually fell much more. Now you would say, why would that happen? And everybody's hoping that the pivot will save the day. And the reason is very, very simple. When does the Fed pivot? The Fed pivots when it believes that the economy has slowed down enough and not to be inflationary, right? So that inflation expectations have really come off. Well, by the time that happens, it would really be a recognition that the economy is either slowed down or already hit a recession. In the past, that's what the case was. I mean, they started cutting rates when they thought the economy had slowed down. Even that didn't work. It eventually went into a recession. They again cut rates. So they had to cut rates multiple times before even the market bottomed. You can check that in 2000. You can check that in 2008. So both of those periods, they had to make multiple attempts at actually cutting rates, weakening the dollar and getting the markets to reverse. It didn't happen in one shot. Reason? Because when you're tightening, you tighten to the point where you actually slowed the whole thing down, kept the thing from moving. So the US markets were overheating. Alan Greenspan thought it's time to raise rates and, curb that overheating of the economy. When he did that, it didn't work in the first go. He had to raise rates multiple times before even he could keep the market from going up. Eventually, the dollar broke the market. Interest rates were higher, and then they started to be cut. And once they started to cut it, the economy was still weakening, they were still cutting, still weakening. And so that is the point at which the bond market reverses first. But because the economy is still weakening, what happens is money moves out of equities, buys bonds, which is considered the safe asset. So the flight to safety trade kicks in once you recognize that there is a recession. We haven't reached that point yet. So each of those events do not happen all together once. So you think that, pivot, dollar peak, it's all going to happen at the same time. But it might not. There's always going to be a lead lag, because by the time one macro factor is played out, it has broken something in the second and the third, and they take their own time to recover from it. So first we recognize that hiking rates has hit the economy enough and you have a recession. When you've reached that point that you've recognized it, the markets may not immediately reverse because it takes time for economic activity to pick up. But why didn't that happen in 2009 or 2016, 17? Why did things immediately pick up? Because there was one differentiating factor, and that was QE, right? So again, when you're making these comparisons, you have to see the differentiating factor, because the people who are saying pivot are basing it on the 2018 pivot that the Fed made when there was no inflation, okay? Every other time, the other examples which I'm giving where pivots caused the market crash, there was no QE. Okay, so there was no QE, and so it took time for the market to really recover. Once the economy starts to weaken, the economy has to recover on its own. Just by cutting rates, it doesn't work. Why? You cut rates. You tell the bank, go lend. Bank says, yeah, but the business is not doing well. I'm not going to lend to them. So they wait. Then they say, okay, I'll cut rates more, go lend. And so it takes time for that decision making to where you actually start lending to somebody and saying, okay, fine, the business is doing well enough that I can give him money. Or the business says, fine, rates have come down enough so I can afford to actually borrow some money and spend it on business growth. That turning point doesn't come. What did QE do? QE said, fine, forget all this. We need a solution right tomorrow. We give the money to the banks and we tell them, boss, you have to lend. Okay, so that's sort of a very indirect way of saying it. It's not directly like that, but that's an indirect way of directly stimulating the market. And right now we are quantitative tightening. They're trying to pull out and away from the excess money deal that they were doing for more than a decade. And unless they really go aggressively back into that, if you're purely managing through interest rates, you'll have to compare the current cycle with what happened in 2000 and 2008, which means recession, bond market bottom, equities might still weaken, even as interest rates are being cut, till the point where the economy recovers on its own, unless you're going to do some fire stimulus to it. If you're going to just throw free money at the market, that could be the only way you get an immediate recovery. Simply cutting rates is not going to do the deal. And so don't just count on that day where the pivot happens and rates start getting cut for a complete market reversal. So I think given you a lot of inputs to think about. Some of these things I've discussed in several of the different webinars and seminars that I've done recently. And this is the situation we are in after the Federal Reserve has really met last week and given its outlook. And you really need to weigh that in, because this is the old saying that you should go by, that is, don't fight the Fed. This is what they're doing today. Look at the situation we are in today. Don't try to guess when they're going to change, when they're not even committed to doing so. Listen to what they want to do. And the Fed has had this policy of transmitting its change in policy well in advance. They don't just come out and overnight change something. They only had to do that in 2018, like I said, when there was no inflation, and they had to pull back from a particular policy direction. But that's not the norm. That's just not the norm. So you can't take one outlier and make it the norm. Okay, so they're going to communicate policy changes in advance. So you wait for that to happen and change your positioning and understanding of the market accordingly. Don't try to guess what they're going to do next because you think you're smarter than the Fed. So don't fight the Fed. That is the final input I can give you in today's communication. Thank you.